Welcome back. Of course, we've just seen the decision there by the South African Reserve Bank's Monetary Policy Committee to hold interest rates unchanged and keep them at 6.5% for the repo rate, the prime lending rate then at 10%. Let's unpack all the permutations, everything then that was said by the Reserve Bank governor there in that discussion. In studio, I'm joined then by John Loos, who's FNB Property Sector Strategist. John, thank you so much for the time.
It's a pleasure.
Unsurprising, really, surely, right? So it's a decision that we all kind of expected here.
Well, I mean, I think there was possibly a debate about a cut, but yes, our expectation was the most likely was unchanged. It turned out that way. He gave in the end, he summed it up by saying the balance of risks is, the risks are balanced to both sides. The inflation rate is near the midpoint where he likes it to be, 4.3%. So not a lot to be done, really.
My worry, though, is that with us having said that the risks are a bit balanced, is it not perhaps a time for them to try and encourage and boost as much as possible? It's not, as he said, it's not as if the risks are overly to the downside, so we're not going to get too much hurt. And it seems that the oil saga is certainly coming to some sort of peaceful end in a way. Should it not have been a time perhaps for them to be a little more bold and decide to, perhaps cut a little?
I'm not convinced. Our Reserve Bank has a history of probably not being bold. If I look at what the US Federal Reserve has done in bygone years to stimulate growth, and I think that stood us in good stead. A central bank, at the end of the day, in my view, is there to look after macroeconomic balances, to keep things sustainable, not to cut rates and boost consumer debt unnecessarily or anything like that. And growth really needs to be driven by structural change to the economy, good government management, good microeconomic management in certain industries, a whole host of factors that we know we've heard a lot about, which falls totally outside the ambit of the Reserve Bank. Right now, the way Reserve Bank policy is, it is very accommodating by our standards, given where our inflation rates are. I don't think we can say these interest rates are high. And they're very stable. And I think there's a lot to be said for stable monetary policy, not moving too fast, either downwards or upwards for that matter. So I think it creates stability, it promotes stability, and that's a good thing. Yeah.
As I asked you my question there, just about whether they're bold enough or able to move forward, it actually reminded me of the sentiment that Donald Trump actually said towards Jerome Powell, the US Federal Reserve Chair, and he said that he had no vision and no sense because he should have cut interest rates a whole lot sooner. Do you think that cut in interest rates from the United States played a part, and how heavy a part it may have played in this decision by the local bank?
Well, when a central bank, a major central bank such as the US is leading cuts downwards, as they do, it possibly provides scope for, at some point, for us to cut as well, to go in sync with them. So it was probably discussed, but if one looks at, they look at the local risks as well. We do have rising government debt. We know that. We've got the risks of downgrades that's widely speculated about. That if downgrades happen, and if there is a significant loss of confidence in investing in our government debt, for instance, you can see pressure on the currency, and that reintroduces imported inflation very quickly. So there's those locally or homegrown risks which can create inflation at the sort of drop of a hat. The other day we had the Saudi attacks. Suddenly oil prices were elevated. It's not bad at this point, but it just highlights those geopolitical risks which can drive inflation through things like oil prices. So there's upside risks, and then on the downside there's major central banks relaxing on monetary policy. Put that all together and you've got quite a balanced inflation outlook. I think what they're saying about the balanced inflation risks and outlook is realistic. So then you tend to be boring and do nothing.
Here's where I play devil's advocate. The mandate, or supposedly the need to keep things between 4 and 6%, 3 and 6%, shall I say? My apologies. Is one that was handed to them by government. They went and made that even smaller and decided now to make it 4.5, and we've accepted that. Why? Because surely It's at 4.5%. You've just said the risks are balanced. And I'm just playing devil's advocate here, so it seems like I'm just advocating for a cut in interest rates. But surely at a time when things aren't as great as we'd like them to be, we should be able to pull a particular lever, maybe, even if it does hinder a little bit on our, how people view us as a central bank.
Well, I'm not sure that pulling that lever, I think there's an overemphasis on what that lever pulling is going to mean.
Yeah.
Back in the late 90s when they pulled the interest rate lever sharply, at that point, there was a low level of household debt.
Sure.
What happened? We eventually had too much debt. That's all. That's ultimately that happened. Now we're in a situation where that debt to disposable income ratio has come down somewhat to 70-something%. That's still high by our historic standards. I don't think the Reserve Bank wants to cause unnecessary pain or anything by hiking interest rates. I certainly wouldn't advocate that at the moment. But if it keeps things relatively stable at a level where you're not encouraging massive consumer debt growth, I think at the moment is a good thing, because while it might hamper short-term growth, because sharp growth or significant growth in consumer debt or housing debt can actually boost short-term economic growth, but where does it end? Where does it land us ultimately? It lands the consumer in trouble somewhere down the line. At the moment, we still have a high debt to disposable income ratio. That's a reality for our standards. So I don't think using interest rates to push that up to drive economic growth is the solution. I think the solution is elsewhere with positive structural reforms, which have been much talked about, the electricity sector and others.
Yeah, I mean, the governor himself spoke about those, right? Saying that we've had so much time where we've spoken about the need for reforms. We're glad they're finally having the conversation. Do you think, though, that there's enough in there to perhaps help the saga when it comes to growth? They still expect growth of 0.6% this year. They've downgraded in 2020 to 1.5 and downgraded 2021 to 1.8.
Yeah. No, look, there's not enough at the moment to help growth. Unfortunately, we've got a pretty poor growth outlook by most economists' forecasts, and ours included. But, if you look at where interest rates are at the moment, let's look at one of the big macroeconomic numbers, the current account deficit. Yeah. It's been in deficit for many, many years, and it's a very significant deficit. That means that gross domestic expenditure exceeds national income.
Sure.
This is not a conservative monetary stance. Where it is now, it's a monetary stance which accommodates a country or allows a country to live beyond its means and pile up the foreign obligations to fund that deficit. That's the big picture.
Yeah.
That's not do you want to make that worse? Because ultimately then you can start running into serious rand volatility and all the uncertainty that it brings, which is bad for growth somewhere down the line. So, we're a country that for quite some time has been living beyond its means, as reflected in a constant current account deficit. Yeah. I don't, if we had a big current account surplus as a country, then you could possibly raise the argument and say these interest rates are too tight. But that hasn't been the case for many years. Yeah.
So you reckon interest rates are okay where they are in terms of the global picture as well? It's generally high, though, compared to everyone else. And I mean, we even have countries sitting in negative interest rates, right? So
well, our interest rates are high compared to many others, but you have to look at them in real terms, adjust them for inflation. You have to look at where our structural inflation is, more or less, let's say 4.5% these days. It's not a 1% inflation economy or so like some developed economies might be. So that requires a higher level of interest rates. And I think what we've also got to just bring in, if we take this back to the consumer, and this is, I've in the past been quite excited on a TV program about an interest rate cut, and then some elderly person phones me in not such a good mood, and they remind me that they are earning interest on deposits. Yeah. There's that side as well. Yeah. Do we just benefit the indebted all the time? There's another side of this economy too. There's another side of the consumer. It's those that save, those that have fixed deposits with interest rates receiving income. do we just penalise them with interest rates? I think not. I think you've got to strike a balance there too.
A bit difficult though, considering that as you've noted, household debt in South Africa is still very high.
It is very high. And I think it would be healthier for that debt to disposable income ratio to be below 70%.
Yeah.
There is a certain amount of debt which is acceptable. It's always difficult to know exactly where that is.
Yeah.
All I can go is on our historic standards and say it's high.
Yeah.
And there's plenty of reports about the pain that the indebted households of South Africa experience. Regularly you read such reports, and at this stage, with a weak economy, with a tough job environment, I don't think we want to encourage that ratio to rise at the moment. To keep it stable would be a better idea, I think, for the time being.
What has happened to house prices in the meantime? I mean, have you seen sort of changes because of the stability, I suppose, in our interest rates of late? I mean, we've only moved once this year, twice this year, yes, but effectively it has been pretty stable. Yeah,
our house price index shows price growth moving along at 3.5% odd. The average for the year, I think, is 3.5% year on year. Very stable, low nominal growth rate. Now, you might say, well, isn't it time we stimulate that? Probably not. I think that the housing market and the commercial property markets, both, they're expensive by our historic standards.
Sure. Okay.
And those price levels are not in line with our economic fundamentals at the moment, which are very weak. And ultimately, I believe you want a market that is in line with economic fundamentals, whatever that may be at the time. We're not that 5% growth economy that we were prior to 2008. Don't think they're fully adjusted yet. They are busy adjusting. First prize is that house prices adjust, or property values for that matter, commercial as well, that's the side I look at more, that they adjust gradually. And I'm always in favor of something to adjust gradually instead of shock treatment. And at the moment that is the case. They are below general inflation as measured by GDP inflation or CPI inflation, these growth rates in property markets in general, and therefore we're having this gradual real price adjustment down more into line with economic fundamentals, where the economy and the people in the economy will be able to afford to transact more readily. That's probably got to happen. The slower and more gradually that happens, to me, the better. You don't want this big economic shock which may send it into nominal decline. But to hope for positive real house price growth or any property value growth at this stage, where property values are already high and you've got an economy hardly growing, I think that's unrealistic.
Usually people have a term for the area you sort of sit in, whether it's a buyer's market or a seller's market, really. It surely isn't a seller's market either way, though.
No, it's not. It's definitely become more of a buyer's market in property in recent years. Yeah. You can see that on our residential surveys by a lengthened average time on the market, for instance. You can see it. There are surpluses in our commercial property surveys too. There's ample stock in most of the big markets. So that's where we are. Yeah.
Okay. If we talk about the overall growth picture, really, just to get towards the end, I suppose there's always been the sense of, for one, they say that electricity prices are higher than expected. There's a limited policy space to react to many other shocks. We don't have a low inflation problem. All of those permutations come to the fore, and you realize that, and even with growth of around 0.6% this year, we're not sitting as a country that looks like the most industrialized in Africa. Are we perhaps too concentrated on other issues and not focusing on the matters at hand right now? And are we perhaps lagging behind on the things we should be fixing?
I think you could say that. I mean, not to go too deeply into political issues, but there are these big political battles that are playing out, and while they are playing out, they can be a distraction to a ruling party, to a government. So. Yes, politics that's a function of the economy to a certain extent. Politics tends to heat up when the economy stagnates. Yes. That's as a rule of thumb. And I think you can see it in a place like the United States as well, where there's certain industries, people that have been marginalized, relatively speaking, and they've voted in someone like Donald Trump. and politics has become more aggressive and more combative in the United States. Britain voting for Brexit.
Yeah.
It's a world issue. And I think it has a lot to do with, politics influences an economy, but an economy also influences politics, and it's got rougher because we're in a phase of economic stagnation. So, and it becomes a distraction. It becomes a distraction, and we need serious policy reform. What economists would call positive policy reform, which boosts economic growth sustainably. We need that desperately, but there are other battles being fought and issues events playing themselves out, which I think are a major distraction.
We also have the rand in 1488 is what they currently sat at with an implied rate, 1440 compared to the last period. The rand has certainly improved though in a sense, because we went from 1440 right through to 1530 odd. Yeah. Right then back to around, now we're sitting at around 1461 with a slight improvement today. So undervalued still for the local currency. So we're supposed to be looking even better.
Yeah, I mean, undervalued, that would be in terms of purchasing power parity. But, the markets do at times price in a certain risk premium as well. And, if you start taking that into account, maybe not undervalued, then it becomes debatable. So, I think the rand is cheap in terms of purchasing power parity. My feeling is if I were to travel overseas to the United States or to Europe right now, it would be rather expensive for me. So from that point of view. But there are very significant risks that we face at the moment. The governor did talk about those, and I mean, government finance, government debt, and rising government debt to GDP ratio are a key one. And how sustainable is this situation? We are getting more and more speculation about IMF bailouts. That's not a nice space to be in. So whether it comes to that or not, very difficult to predict, but certainly the perceived risk of that has been rising, and that can at some point that runs a risk to your long bond yields, to your even to other markets, your equity markets and so on, and your capital flows and your currency. Yeah.
Okay. For the remainder of the year, we have one more interest rates decision for this year. Do we get a cut? Do we keep things the same way for the remainder of the year?
Our first round forecast is that we will get a cut. That will possibly be the last one in the cycle, but that it's a very mild cutting cycle, because we are at relatively low interest rates at the moment, given where our structural inflation is. But that, yes, we can before the year is out.
So what will it depend on? Will inflation have to head a little lower as well? Will the oil price spike obviously have to have been subsided completely? Will the Fed have had to have kept the notion that they'll continue to cut interest rates? What exactly are the permutations we need to get to that point, hopefully?
I think a lot depends on what comes out in the medium-term budget.
Yeah,
that would be a big one. And to what extent the Minister of Finance can make the markets comfortable with the idea that there is a plan to fund and turn around these parastatals before government debt gets out of hand.
Yeah,
I think that's so that will be the next month's medium-term budget statement will be a very closely watched item.
Yeah,
but yes, I suppose no more Saudi attacks. That would be another one. If this is a once-off and you go back to normal business as usual in the oil markets without any further disruption, we're looking then at an inflation situation which is very much under control.
Yeah.
But these things, you're not going to predict them. You're not going to predict any further attacks.
This is me holding thumbs for a rate cut in November. Need to pay off that bond ASAP. Thank you so much for the time, John. Appreciate it. John Loos, Property Sector Strategist then at FNB, helping us unpack that market picture and just really what the South African Reserve Bank, it is your breaking news this hour then, as the South African Reserve Bank has decided to keep interest rates unchanged, 6.5% for the repo rate, the prime lending rate still at 10%. South Africa's currency still doing slightly better, 1463 on the day. Not too much movement. That's versus the US dollar, of course. Nearly 4% better off this month alone still. for the South African currency. Just overall, with some other news as well, then, of course, the permutations around Moody's and whether they decide to downgrade South Africa. As they've said, they probably will not, but, the chances are still there of an outlook change at the very least. Credit Suisse even saying that we could lose as much as 4 to 8 billion US dollars. That's around a maximum of 118 billion rand if we do lose that investment grade status when it just comes to Moody's as well. And the midterm budget policy statement, well, confirmation then that it will be on October 30. The finance minister having that perhaps just a week later than usual on that front. Of course, we'll give you all of the latest information on that, and as it happens, we'll have that right here on SABC News. Thank you so much for joining us for this special live broadcast, of course, of the South African Reserve Bank's Monetary Policy Committee meeting. 6.5% for that repo rate. We'll chat again soon. From me, that's where the buck stops.